What if a U.S. president openly confronted the Federal Reserve and jeopardized decades of central bank independence? That's exactly what happened in July 2025, when Donald Trump turned a $2.5 billion renovation into a political weapon and publicly attacked Fed Chair Jerome Powell in an extraordinary institutional showdown. In a rare visit to the Fed's Eccles building on July 24th, cameras rolled as Trump accused Powell of mismanaging the renovation budget, claiming it ballooned to $3.1 billion instead of the official $2.5 billion. Powell, unusually direct, hit back immediately. The extra amount, he explained, included a building completed years ago. Trump was either misinformed or manipulating the numbers. But the moment had already become historic. That confrontation wasn't just symbolic. It shattered decades of precedent. A sitting president, on camera, attempting to publicly pressure the central bank chief to cut interest rates. The setting? Not a campaign rally, not a private conversation, but the heart of U.S. monetary power. This is more than a disagreement over inflation or interest rates. It's the clearest sign yet that the independence of the Federal Reserve is under attack. And that has serious consequences, not just for markets, but for the entire global financial system. Imagine this. A CEO barges into the office of an external auditor, insults their intelligence, questions their budget, and demands changes to accounting policies, all in front of the press. That's what we witnessed with Trump and Powell. Except in this case, the stakes aren't just corporate, they're systemic. But why now? Why has this feud escalated to this point? Today, we dig into the nature and origins of this clash, analyze how it rattled markets, and lay out practical investment strategies in a world where central bank autonomy may no longer be sacrosanct. At the root of it all lies a fundamental disagreement over what the Federal Reserve should be. For Trump, the Fed is a tool, an instrument that should accelerate growth when Republicans are in charge, and tighten things up when Democrats are. It's not about economics. It's about control. He wants rates low, markets high, and growth at full speed as he heads into the election year. Jerome Powell, on the other hand, represents a tradition that dates back decades: central bank independence. For Powell, decisions should be driven by inflation, employment data, and long-term stability, not political cycles. Since December 2024, he's kept rates between 4.25% and 4.50%, aiming to curb inflation hovering around 2.7%. He's resisted political pressure, focusing instead on steady signals, cautious moves, and credibility. That resistance has made him a target. Trump's team, rather than pushing for a direct dismissal, something legally and politically complicated, has chosen a subtler form of pressure. Budget Director Russell Vought called the renovation a Versailles-style waste. Treasury Secretary Scott Bessent floated the idea of reviewing Powell's performance, even suggesting that the Justice Department look into testimony inconsistencies. Allies began calling for hearings. Rumors of criminal investigations emerged. The message was clear: resign or we'll make it very uncomfortable. But Powell didn't back down. In a rare press moment, he stated plainly, "I have no intention of resigning." His stance? If the central bank folds now, it opens the floodgates to future manipulation. The Fed's credibility, built over decades, would be gone overnight. And so the pressure builds. Markets have felt it. In the days following the confrontation, the S&P 500 dropped nearly 1%. The dollar fell. Yields spiked. Investors started to price in not just rate cuts, but chaos. Deutsche Bank warned that if Powell is pushed out, the dollar could lose up to 6% of its value. HSBC flagged political interference with the Fed as one of the top risks to financial stability going into 2026. Here's why it matters. If the Fed's independence is compromised, inflation expectations start to shift. Investors worry that rate decisions won't be about fundamentals anymore. They'll be about politics. Workers demand higher wages preemptively. Businesses raise prices in anticipation. Before long, you've got a loop, a self-reinforcing inflation spiral. The Fed tries to fight inflation, but no one believes it's really in control. It's like pulling the anchor off a ship in a storm. Even if the captain's steady, without that anchor, the vessel drifts. And the geopolitical implications? Massive. The United States has long held its position as the world's monetary anchor, largely because of the Fed's credibility. If that's gone, capital starts flowing elsewhere. To the Eurozone, to Japan, even to digital assets. In Brussels, European central bank officials are already positioning themselves as the last bastion of monetary stability. Japan's central bank, traditionally cautious, is now viewed as more reliable than Washington. The irony? Trump's pressure on Powell might just elevate foreign currencies at the dollar's expense. So what do investors do in the face of this shift? First, geographical diversification is no longer optional. It's essential. Reducing exposure to US-centric equities and bonds and rebalancing towards Europe and Asia offers some insulation. Think pan-European ETFs, Japanese infrastructure funds, or Asian emerging markets with stronger monetary frameworks. Second, inflation protection needs to be front and center. Treasury inflation-protected securities, TIPS, offer direct shielding. But don't stop there. Physical gold, commodity ETFs, real estate, especially sustainable infrastructure and green energy assets. These often move independently from traditional markets and serve as long-term hedges. Third, liquidity is king. In volatile environments, the ability to move quickly is priceless. That means keeping higher cash reserves, holding short-duration bonds, and exploring structured products that offer downside protection. It also means considering staggered investing, dollar-cost averaging over time to absorb price shocks. And finally, stay politically aware. Powell's term ends in May 2026, but anything can happen before then. A resignation, a legal battle, a surprise replacement. Investors need to monitor key events, FOMC meetings, CPI data, labor market shifts, and political messaging. Sometimes, what's said in a press conference matters more than what's printed in a report. All of this leads us to two likely scenarios. In the first, Powell stays. He resists the pressure. Markets stabilize. Inflation trends downward. The Fed may start cutting rates by late 2025, perhaps September, if inflation permits. Bond yields normalize. The dollar holds. And confidence gradually returns. This is the optimistic scenario, and for now, it's the most probable. In the second, Powell steps down or is pushed out. A Trump-aligned replacement is confirmed. Markets panic. The dollar drops sharply. Treasury yields spike. Stocks wobble. Gold surges. And faith in U.S. monetary policy fractures. Investors flee to quality, euros, yen, commodities. Inflation rebounds, and the Fed loses its most powerful weapon, trust. In either case, your strategy must be proactive. If stability holds, allocate gradually. Rebalance, be selective. But if chaos emerges, don't wait. Diversify into global assets. Increase exposure to real assets. Protect downside risk. Because if the world loses faith in the Federal Reserve, the ripple effects will be global. We're not just watching a feud between two men. We're witnessing a potential turning point in financial history. A moment where the future of central banking, market stability, and global economic leadership could all be reshaped. So here's the bottom line. The Trump-Powell confrontation may seem political, personal, even theatrical. But behind the headlines lies a much deeper story about power, policy, and the invisible machinery that holds the global economy together. Smart investors know that change is coming. The question is whether you're prepared to navigate it. If this breakdown helped clarify the stakes, consider subscribing for more insights at the intersection of money, politics, and markets. Stay informed, stay diversified, and stay one step ahead.